Investor YouTube channel back with another video. If you're new to the channel, please consider subscribing. I'm looking to build a platform for like-minded investors on the path to becoming financially free. We are now well on our way to the 200 subscribers goal, and if you like today's video, be sure to smash that like button to help me get this out to more people. That being said, let's get into today's video. 6 new stocks that have been added to the Freetrade platform this week, all cannabis stocks. I plan to talk through each one, then provide a brief summary at the end of key takeaways from each. Please do remember, guys, I'm not a financial advisor, and before investing, you should do your own research as your capital will be at risk. This video is purely for educational purposes only. Cannabis stocks have now recently been added to the platform. Before going into each, I thought it would be a good idea to talk through a brief history of cannabis stocks, inspired by the Freetrade subscription email. People have been smoking weed for a long time. The laws that have restricted its use for the past century or so haven't changed. Many of those restrictions are starting to disappear, though. Several US states have made pot legal, and so have Uruguay and Canada. The UK made medical cannabis legal in 2018, though other restrictions mean it has not been widely prescribed in any form. Most cannabis stocks have seen substantial growth over the past 5 years, and this is mainly attributable to their growing popularity. Cannabis companies have seen large amounts of hype around when they going public in the past few years. They can often be a negative thing in the long run, as too much hype can lead to market bubbles. So what about the future for cannabis stocks? Much has been made of the growing laxity of laws governing cannabis use across the world. A loosening of these rules would probably make it easier for cannabis stocks to carry out research and sell their products. Okay, now for the 6 stocks added to the Freetrade platform this week. I think what I mentioned earlier in the video will be helpful as context to a lot of the information I'll be providing. Getting into the first stock is Tilray. A share price from its high in 2018 of $115 to a low point in 2020 of $3, it is clear this stock has been on the decline, with the current price hovering around the $10 mark. The entity has consistently underperformed both the pharmaceutical market and the general UK market. Looking at the valuations, we can see that Simply Wall Street analysts are saying that this stock is currently undervalued by 90.5%, with an analyst fair value of $100. As the entity is loss-making, we cannot discuss a PE ratio, but if we scroll down to the price to book ratio, we can see that this is slightly above the industry average at 6.2. If we look at the future growth, the earnings in this future growth is expected to be 83.5%, with the entity expected to return to profit in 2023. From 2020, revenue of 179 million, the entity is expected to increase this substantially to 427 million in December 2022. Of course, this will be contingent on the regulations and popularity being favourable. It should be noted, and you will see from the other stocks, that forecast growth is optimistic in all stocks. Looking at the financial position of the entity. Looking at this, we can see that the short-term assets of 339 million exceed the short-term liabilities of 171 million. However, they are not enough to cover the long-term liabilities at this point. Looking further at the financials of the company, we can see that it has 194 million of cash, 205 million of physical assets, and almost 100 million of inventory. I would like to know more about the long-term and other assets which individually exceed the other items. That is the large big red block we can see at 477 million. This does raise significant questions, which then has a direct impact on the debt to equity ratio, which is a whopping 250% and considered very high. Unfortunately, the entity does not pay a dividend, and that is a very much downside of the other 5 stocks that we're going to discuss as well, as none of the 6 stocks pay a dividend. Let's move on to stock number 2, which is Aurora Cannabis. Again, similar to Tilray, This has had a share price decrease from highs in 2018 of 161 Canadian dollars to a low in 2020 of $1.98 Canadian. In some recent news, Aurora announced they would lay off 500 employees as part of a restructuring of its spending plans. According to Simply Wall Street, the analysts believe that this stock is undervalued, similar to the previous stock that we looked at, and believe the current price of low 20s is undervalued on a fair price of just below $100, being an undervalue of 76%. Again, the entity is not profitable, so there's no PE ratio to discuss, but we can look at the price to book ratio, which is 0.2, and is a massive tick in this box. Looking at the forecasted growth, a greater than 80% forecasted growth again for Aurora Cannabis. Similar to Tilray, the entity is expected to return to profit making in 2023, where it will look to grow revenue to $750 million. Looking at the financial position analysis, if I scroll down to it now, we can see significant long-term assets of $4 billion, and we will discuss this below further. Before then, we can see the short-term assets do exceed short-term liabilities, but not quite enough to cover both short-term and long-term liabilities. In-depth look at the financial position then. We can see that long-term assets are 3.2 billion, and this makes up the majority of the assets. These can often be made up of investments or intangibles, which in certain regulations are imposed, can cause an accounting principle called impairment, which is a non-cash related adjustment to earnings. We can see 500 million of debt, but looking at the assets, this seems well maintained. Debt to equity ratio is a fantastic 13.1%, which is much better than Tilray stock. With no dividend to discuss, let's move on to stock number 3. Canopy Growth. With a market cap of 8.2 billion Canadian dollars, and looking at the share price, we can see an increase in share price from 2018 up to a maximum price of just short of $70, then a steep decrease in 2019 to the low of $15. Similar to the previous two stocks, we can see that Canopy is underperforming both the market and industry. And again, another stock which analysts believe is undervalued based on a fair value of $64 compared to the current price of $22. Again, an unprofitable entity, so no PE ratio. I do promise at least one of these 6 entities is making profit, but the price to book ratio here is 1.6, which is deemed reasonable. Looking at the future growth, similar to the previous two, it's in the 80s and profitable in 2023, with revenues expected to exceed 1 billion and become 1.4 billion in the year 2023. If we then scroll down to actually look at the fundamentals of the business, Canopy are much more positive, with short-term assets covering both short-term liabilities and long-term liabilities, with a significant holding in cash of £2 billion, which is nearly 4 times covers the debt balance of 465 million. Debt to equity ratio of 9%, which is a good ratio to have. As there's no dividend to be discussed, on to stock number 4. Stock number 4 is GW Pharmaceuticals. In the 3 years after its founding, private investors pumped around $40 million into GW Pharma. That money was used primarily for medical cannabis research. GW Pharma's success on Nasdaq ultimately led to the company to delist from the AIM in 2016. Its shares are now only traded on the US exchange. GW Pharma's products have clearly played a big role in the huge increase in its share price. The company's revenues leapt from 15 million in 2018 to 312 million in 2019. After it started selling Epidiolex in US, but there are other factors at play here too. US investors have been more open to putting money into biotechnology and pharmaceutical companies. In 2019, for example, biopharma companies raised $92.7 billion from US investors, equivalent to 60% of global fundraising for the industry. By comparison, European companies only raised $27.5 billion. GW Pharma shares have been very volatile. They began trading on a Nasdaq at $8.90, rose to $110, and before crashing down to $35 after a failed drug trial in 2015. They took a roller coaster ride up to $184 in May 2019 before crashing down again. They are now trading around the $130 mark. Analysts suggest that again this stock is undervalued by 77.4% based on a fair value of $670. Finally, we have an entity that is actually profit making. So we can see that a price to earnings ratio of 120 times, and this does seem somewhat overvalued, regardless of what industry it's in. But looking against the industry average of 15.5, this is significantly overvalued. In addition to this, the price to book ratio is 5.6 times, and this would also suggest overvalued. Growth of the stock is expected to be less than the previous three, but still an optimistic 61%, with revenues expected to break the 1 billion in 2023. This seems to be a golden year for all these stocks so far. Looking at the fundamental financials, we can see that short-term assets significantly cover liabilities, and it's quite impressive to only have 35.9 million of long-term liabilities. With cash over $500 million compared to debt of just 9 million, the company looks very stable, making the debt to equity ratio just 1.3%. Although it does make you wonder, should they be utilizing more cheap debt in the current situation? A quite impressive stock, and probably the longest lasting and first profit making one that we've looked at. I'm sure many of you will like this one, although no dividend stock again being paid. Let's move on to stock number 5, which is Cronus Group. At a market cap of 3.1 billion Canadian dollars, a share price starting at less than $1, it has rose to a peak of $30 in 2019. It has started to decrease since then to a level of around $10. Interestingly, this is the first share that analysts deem to be overvalued. A negative future return of 26.6% is significantly different to the other stocks that we were looking at. Sorry, I've just skipped over the PE ratio, which is actually just 2.4, which is fantastic and does suggest that the entity is profit making, which it is. 2.4 is a great ratio to have, and actually the price to book ratio I don't think was too bad at 1.3 times against the industry average of 1.2. What we can see, as we previously spoke about the potential negative growth, we can see a significant earnings increase in 2020. This would have been drove by a one-off item, because what we can see if we click on the free cash flow is that actually the entity was still plugging away at a negative cash flow. This, I would suggest, is relating to a one-off write-off or impairment, as discussed previously in this video. So what about the financial position of the entity? Well, we can see from the short-term assets do cover short-term and long-term assets, cover the long-term liabilities. And that long-term liabilities are just 11.4 million, which is impressive. This is fundamentally due to the business being debt-free. Although being debt-free is not always the best for companies, and a little debt or manageable debt can help the business grow if managed well. Again, no dividends, so on to our final stock, stock number 6, which is Afria. With a market cap of 1.7 billion Canadian dollars, the current share price is around $5, and this is closer to the bottom range of the maximum and minimum of 19 or close to 20 Canadian dollars being the maximum and $7 being the lowest point of the stock. If we then look at how the analysts value the stock, we can see that again it seems to be an undervalued stock by 71.2%. with an expected fair value of just over $20. We have another entity that is profit making, but a PE ratio of greater than 50 might put some people off. The price to book ratio is less than 1, which does seem very positive at 0.9. Future growth appears to be more conservative on this one. So, in the next 1 to 3 years, based on estimates from 12 analysts, they're expecting a growth of 27.1%. And it looks like the entity is forecast to hover around break even, which is particularly strange given the substantial increase that we can see in revenues expected. Revenue is expected to double in the next 5 years to around 1 billion. Let's have a look at the financial position of the entity. Looking at the financial position, we can see that the current assets exceed the short-term and long-term liabilities, which is great. We do have around half a billion in debt, but we currently see more cash and liquid assets, which should be easily managing the debt. We can see a debt to equity ratio of 25.7%, which would be considered satisfactory. You can see that cash value does exceed the debt value there. So that really wraps up these six new cannabis stocks on Freetrade. I think all have had positives and negatives. I think we need to be careful with the levels of debt in some of the entities, as well as the future forecasts of revenue and earnings, which appear to be optimistic. I think for me, if I was required to invest in one, I would select GW Pharma, based on the longer life of the entity, a very low debt to equity, and the fact that the entity is currently profit making. For me, I'm a dividend chaser and not an opportunist looking for a capital appreciation, which is what I believe these stocks are. So I don't think I'll be purchasing any of these at the moment. No dividend is a big put off for me. As I'm not a financial advisor, please do your own research or further research to this video. If you're going to invest, be sure that you understand the risks that might be applicable to your capital. Please let me know if you currently invest in any of these stocks or what one is your favorite in the comments below, and I'll be sure to reply to all. This one was a longer style video with massive value, and I think as many people will be looking at the hype around cannabis stocks, but maybe don't have the information available for them to analyze, this should be a valuable video to many. If you have found value in this video, please do subscribe to my channel and help me get to the target as mentioned before of 200 subscribers. That really wraps up this video, guys, and if you've stuck until the end, I do very, very much appreciate it. And until next time, guys, peace!